Okay, guys, we're going to begin. I'm glad to have everybody here today. So today we're going to be discussing really something that's been pretty significant in our business. And I think it's really impacting a lot of folks all over the country, from corporations to just traditional Wall Street investment firms to groups that are more in our area of real estate. So we're really going to be looking at ways to capitalize on tax reform and kind of dispel some of the wrinkles and wiggles of the new tax reform rule for qualified opportunity zone investing. So let's do a little introduction. I have a partner of mine on with me right now. A little bit of background on myself. My name is Dylan. I've been in really the investment space for about 8 years. Started really from a blessed point of view, I would say. Started working in the hedge fund space, working on options arbitrage desk based out in the left coast of San Francisco. And what I really started looking at was what was the best way to manage risk, and what led me to continue to go there was really understanding what are the different cylinders and levers that investors can have if they're really looking to optimize not only performance, but I think level of comfort and peace with the types of risk they're taking for overall strategies for larger scale capital groups to individual investors. I do have a bit of experience in high net worth advisory, and the current focus right now is more looking at ways to really expand the bridge for investors to optimize, tax impact from an investment point of view. So real estate happens to be really what I would call a grandfather strategy in terms of how it's been impactful over not just a couple of years, but for generations. And everything that we're going to be sharing with you obviously rests on my partner and I's, character and our word. And so we want to put this up front, really elevate the highest level standards in terms of accountability, integrity, and just be completely transparent with you guys. There'll be things that we discuss about particular opportunities or investments, possibly on future webcasts. And so what we really want to make sure is you understand that it's more about, honestly, the relationship and understanding that you guys get value from this webcast. So before I kind of begin, I'm going to introduce a partner of mine. His name is Robert. Robert, you there?
I'm here. Hello, everybody. My name is Robert Lang. I've been in real estate since 1990, so I'm approaching about 30 years in the industry. I've had the opportunity to work for some of the largest private owners. I've been on pre-capitalization teams of REITs. And interesting enough, before they called it opportunity zones, the first property I ever did would have been classified an opportunity zone on the south side of Richmond, Virginia. So I've had experience in opportunity zones for almost 30 years. Been very successful. Have fixed over about $1 billion worth of assets that were not performing. Anywhere from opportunity zone assets to brand new luxury, high rises, affordable housing, etc. Everywhere from Michigan, Texas, New York, Florida, and in between. At one point, I had 12 teams traveling over the country that I would be overseeing, turning around distressed assets. So that's a little bit about me, and I'd be happy to answer any questions more about my experience when we get into the questions.
Cool. Thanks, Rob. So now that we've kind of gone into the background, what we're going to do is I like questions. I like to keep it simple. I mean, this is a big, I would call it an elephant in terms of the legislation from the tax reform. So qualified opportunity zones is kind of like that. So we're going to break it down into like pieces. Just answer simple questions. Many want to understand whether or not these are new. They've been around for a long time. They're relatively new. It's just been passed as of last year. So pieces have come out throughout the past several months about how it's being addressed from an investor point of view, from a tax point of view, but it is something that's been designated through all 50 states in the country. What is an opportunity zone? Uh, you've probably driven through one. You may know somebody that's actually lives in one. I know that we're actually looking at a property right now that we had to look it up yesterday, and it's actually in an opportunity zone. But the standard kind of definition, it's an economically depressed community where under certain conditions may be eligible for this preferential tax treatment. It's something that's been designated and certified by the Secretary of the U.S. Treasury. So that authority really kind of goes all the way up to the IRS, which allows for investors to reap the tax benefits, which we'll discuss and kind of spell out what they mean exactly in a bit. How are they created? So again, we've been throwing around the word tax reform. The actual legislation, the title of it is called the Tax Cuts and Jobs Act, and that was something that we would not be totally correct to say it's a Trump tax reform. It was actually a bipartisan effort that was put together by the Congress. So it is, one fruit of that, which has been helpful. The purpose. So the stated purpose of these zones is really to look at, investment and economic development, and also impact investing in a way that can be married between all three of those. And the design is really to spur economic development and job creation in distressed communities. There's a lot more we can add to this, but what I would say is that the true definition of how we're approaching it is from probably the highest level of impact investing. So, the intention is really to kind of raise the standards of what it truly means to be an opportunity zone investor, and we'll get into that in a bit. Qualified Opportunity Zone Fund. This is basically the proper definition by the IRS in terms of what qualifies as a fund for investors that want to take advantage of these tax benefits through the reform. It's an investment vehicle typically set up as an LLC, partnership or corporation that is investing in eligible property located in qualified ozone opportunity zones. So that means that if you were to invest into a fund that maybe has 25% of its allocation into an opportunity zone, but the other 75% was in the S&P 500, that would not be a qualified opportunity zone fund. To qualify as an opportunity zone fund, the fund actually has to have at least 90% of its allocation inside qualified opportunity zone investments. So that would be the strict kind of guideline to watch out for. This is kind of a question I think that we even had to kind of address early on, as far as most people think of the tax advantages of looking at real estate as like, do you have to be sitting in the property to take advantage of it? But for passive investors and general partners of ours, the answer is no, which is nice because you can still get the tax benefits. And, it's regardless of whether you live or work there or have a business in the opportunity zone. It just really all depends on whether or not you are considered a limited partner or general partner in a qualified opportunity zone fund. And with that, you have the ability to defer the capital gain on that tax going forward on the second disposition, which may sound a little, complex, but we're going to break it down so you guys kind of really get it. This is where I would say we kind of get into the nuts and bolts of the nice advantages of it. So, the question most will think about is like, so when do the tax benefits really come into play? And it's all really predicated on the holding period. So if, for example, you were to buy an asset in an opportunity zone fund and you were to hold it for a year and you were to say, hey, I want to dispose of this asset. Unfortunately, and this, I don't know if this would be most prudent from an investor point of view, according to your plan, which we do foster to have a well kind of written policy for your objectives for investments. It's best to be a long-term investor, right? Frankly, predicting the market and predicting, how things will evolve over a year wouldn't be as fruitful to say is that, growth and fundamental stories evolve over longer periods of time. So the nice thing about that is that coincides with the tax benefits that trigger at the 5-year mark. So upon 5 years, the exclusion of the deferred gain is actually 10%, and then it starts stepping up year after year. So at 7 years, the exclusion becomes 15%. So 5% increase, 5% reduction in capital gains upon disposition. Now, I would say the sweet spot strike zone for our fund and for our group and our investors is really looking at ways to maximize it to the highest potential, which is really going for elimination of the capital gains tax upon disposition, which would be the 10-year mark. So, very powerful gift in terms of, investors, what's going on right now. And so that is more, what we just covered is more of the disposition side, the back end side of the future consequences of investments. Now the front end side is even more, interesting because, it has implications for people that have sold stock, let's say this past year. And by the way, when I say stock, it could, apply to, a piece of real estate like a condo that you own in Minneapolis, or a business that you sold in Texas or California, or just your home. Most will look at, the disposition of asset. Well, we sold it, grand. We need to reallocate our portfolio. That was a necessity, but now the burden comes of what to do with the taxes. So the nice thing about the ruling is that it's going to be allowing for a deferral opportunity for those that have capital gains from any type of asset that I mentioned. So the answer is yes, you can defer paying tax on that gain. And the IRS has pretty clear rules that you can elect to defer to elect that tax on the amount of gain invested in the qualified opportunity zone fund. So it really only applies to the gain, which, I would say that on a bearish market year, beyond, several years ago, it probably wouldn't be as attractive. But given the fact that, we're basically at a point of inflection in the market, in many different markets, particularly the equity markets, many people have actually taken gains in 2018. And then I think what people, are wondering is that, what about 2017? Because, if you were a little bit ahead of the curve and you reallocated and adjusted, maybe liquidated some positions, took some profits, and the year before, people want to know, can they still defer that as well? And interestingly enough, they're actually allowing for that as well. Now, that is going to be requiring a little bit more different approach. And so, what we're really fostering, for our investors is that, we just happen to have an in-house tax department that allows for, pretty expedient amendments to take care of those returns for 2017. So, again, you can just have that impact for your investments. Where are they? So this is an interesting picture, but it's interesting. They're all over the country. I would say that the larger box of opportunity zones are in more rural areas, and as you get into more of the smaller pieces near major cities, that's where you're going to find a lot of the opportunities that we're focusing on that are more multifamily in nature, and just I would call them risk-adjusted, value-add opportunities that are really ripe for opportunity in these environments, given the tax advantages. So I'm going to open it up to questions in a bit. This is a good example of I would call it an opportunity zone investment story that actually was I would call it pre-opportunity zone legislation. So it's a good example of, like, given that our group has been doing this for about 30 plus years, a lot of the properties and investments, acquisitions, redevelopments, they just happen to have been already in opportunity zones. They've been in the right strike zones per se. So I think having a case study to give you guys, kind of a foundation to ask some questions and learn more about is a good learning tool. So what I'm going to do is I'm going to pass it over to Robert, because this is actually a property that Robert spent significant time at. Actually, you were there, over a year, right? Or close to a year working on this property, but it's a great story.
Yeah, I was there for about a year, Dylan. This property was probably the biggest challenge I've done in my whole career. The property was actually being protested in the news. It was every city council meeting. There was a big debate on whether to bulldoze the property or keep it. And the reason the big debate is they didn't have enough affordable housing to transfer folks that live there. And it was a recruitment center for MS-13 gangs, which I didn't know that they were the most violent gang in the country when I'd gone there. So when we got there, it was quite a mess. Everybody that had been in the business as long as I had said basically to me, Robert, if you can do this, you can do anything. And when I got down there, actually the Greensboro Housing Coalition was protesting it. I met with the director, and the director actually believed in us and actually went before city council and made a presentation for us. And city council was a heated debate, but they voted 5-4 to support us. And the reason I share that is on properties like this, to truly be successful, it's about creating a partnership between the private companies, between nonprofit and the city and other local groups to truly transform a community. I've seen too many times where folks go in, they have the money, they've got a great team, but they don't understand what it takes to really turn around a property. For example, we're getting ready to buy a property in Houston, about a 600-unit property, and there's been a string of owners that have failed at that asset, and they actually had money from the city, some tax credits, et cetera. They just didn't have the right plan and the right team in place to turn it around. So this property, we took it over, and even after you dot all your I's and cross all your T's, when you're dealing with a property like this that has this much hair on it, you're going to have challenges. And unfortunately, my construction partner, I found out 30 days into it, could not handle it. And that was the reason that I was down there for almost a year. If I had been down there, it would have been like the maiden voyage of the Titanic. But we were able to turn it around very quickly. Matter of fact, I was interviewed by the news several times because it went from a recruitment center of MS-13 to the most crime-free property in the whole area. Secondly, HUD has a national meeting once every 3 years, and within 12 months of owning that property, we actually won the best turnaround story in the country. So it was a great learning experience. Like I said, I've been doing this for almost 30 years, but after that property, I feel like any of these opportunity zone properties, I go in with my eyes wide open. So it was a great success story, great learning story. And I'd be happy to, if any of you guys want, I actually have a video that we won the award with. Just put that in the comment sections. There's a page I think Dylan will share with you, and I'd be happy to share that with you.
Yeah, guys. So what we're going to do is, out of respect for time, we're going to be doing this every other week. And what I want to do is kind of leave the last 10 minutes for some questions. If anybody has questions, I'm going to unmute some people and just kind of open it up and make sure that, if there's any questions you guys have, I want to honor that. And there also will be an opportunity to reconnect offline. We're pretty busy as well, so we understand your schedule. There's a link in the chat box that will allow you to kind of maybe be more detailed in some questions you guys have, and we can kind of link up at a more appropriate time. But if anybody has any questions, the floor is yours.
Rob, that was in Greensboro where the MS-13 and all the yearly construction project took place?
Mm-hmm. Yep, it was in Greensboro.
Right. And now the occupancy on that group is about what?
It's last time I checked, I'm no longer part of that project, but last time I checked, it was over 90% occupied.
I'll be darned. Oh, that's good.
one thing that I will add, Jim, since you brought that up, the property ended up being, a great success. But one of the things I think in these opportunity zones that I think what the administration's wanting to do is for groups like us to go in there and truly lift up a community, right? Not gentrify a community, because then we're going to be creating more. We already have a large affordable housing crisis in the country. And if we go in there and we just gentrify an area, that's going to move everybody out. So what we're looking to do is to create partnerships to truly lift up the community and the neighborhood. I think that's an important aspect. Thanks for asking that, Jim.
Yeah, I got a couple more questions. If a person invested in this, are you considered a limited partner or a passive investor?
For an LP, the wrinkle on it is actually that's what it describes you as, like a limited partnership. A partnership gives an LP passive investment exposure. So the nice thing about that is that for some of the relationships and families that we've been gifted to serve, many of them they're attracted to this opportunity zone investment like idea of it, but the wherewithal and operational experience tends to be kind of a big gap, and sometimes it's like more of the Grand Canyon as far as how big it is. And so what we really provide is a sense of peace about what is the right group to partner with in terms of placing trust with in terms of your investment. So as a limited partner, you really get that void filled in terms of operational experience, and then you get your passive investment exposure and obviously more importantly the tax benefits.
What if the property that you invest in was sold before the 10-year period? How does that scale out into profit loss, capital gain, what have you?
Yeah, I mean, I think for scenarios that don't take advantage of the maximum potential of 10 years, you're still going to be able to get significant reduction even on a 7-year time frame period. So I think what it really means is that through proper analysis of just your overall written policy plan for your investments is key. So something like that we would probably want to work with you side by side on to make sure that you're kind of really geared up and prepared to do it.
I mean, in you, the general partner, if the property, another REIT or another investor came and said, I want to buy this whole apartment complex for X amount, and you decided to sell, how would the limited partners treat that under the 10-year situation?
So if it was under the 10-year period, we would have to consider whether it's beyond the 5-year period, which I think, would seem fair to say that that's the minimum threshold for a holding period, because that's when the first threshold is hit as far as tax advantages.
5 years.
Back end side. Yeah, upon disposition. I think that there's two approaches to this. One is that, there's a single asset approach, and then there's more of a fund approach. And the fund approach allows you a little bit more of a diversified approach, and allows better control of the actual disposition process. Because in that sense, you have the ability to get the maximum level for the tax benefits for capital gains.
Right. Okay. One last question. One last question in regard to the Tax Reform Act, that was passed. Does the IRS have a publication about these opportunity zones? Again, you say that the IRS has approved this. What kind of publication do they put out that a common taxpayer could review easily?
Absolutely, yeah. Yeah, no, that's a good question. What we're going to be doing is actually putting together a brief overview on the actual rules that are being kind of digested from the IRS website. So it's easily kind of read. But it is spelled out pretty clearly if you were to go on the site right now. But what we're going to do is kind of give you a good idea of how to address it, because for somebody that, say, for example, has gains that they may want to defer from 2017, that's going to require a little bit more work, but we're prepared for that. We've already started doing that with some other clients.
Talk with your CPA about this too.
Yeah. But, it's all worth it in the end. And, a simple adjustment and amendment from a tax return is significantly outweighed.
I wasn't much about 17. I was thinking about the future, like 2019 and 20, and just what the IRS has actually published.
Yeah. No, they've actually published a significant amount of detail, and, I'd be happy to provide you more detail about it so you can get your hands on it.
Yeah, that'd be great. All right. Well,
absolutely.
I think a lot of questions, and I guess ready for the pop quiz.
Okay.
Which I hope Robert, there won't be one.
What's the first question, Robert? Do you have a question, or you have the first quiz question?
I actually have a question on the opportunity zones. I just wanted to clarify. I think I understand it. So, say we buy a value add asset like Pinecroft Apartments, and just to keep things all simple, we're all in 10 million, and we increase the value, we'll say, to 20 million. Even though we can't sell the asset, we can refinance the asset and pull cash out without incurring any tax consequences, correct?
Yeah, correct. I mean, that's a standard benefit of just investing into real estate. You have tax-free refinance opportunities that can be redeployed into, second opportunities, or just thrown out as dividends. But, again, I think what we want to respect is just the idea of like what serves the investor the most. So for each, investor, their considerations to how they want to mitigate tax exposure is going to be key, and understanding how, yeah.
Everybody gets a K1 once a year, right, Dylan?
Correct. Yeah.
Okay. All right. Well, it's been very informative. I appreciate it, you guys.
No, not a problem. Honored to have all you guys on the line with us. What we'll be doing is putting together a replay of this, actually, so it'll be available for replay. And then, as I said, we're likely going to have this every other week. And going forward, we'll have different capital groups online with us, and we'll be kind of digging into opportunities that have since been acquired and redeveloped, success stories, and then new potential opportunities as well. So look forward to having you guys on, and nice meeting you all.
Thank you.
Okay. Hey, same phone number, same PIN number?
Yeah, same phone number, same PIN number. And then I think what we'll do is, for those that registered through different means, we'll provide a link to register for the next time and send out an email, okay?
Awesome. Thank you.
Okay. Thank you, guys.
You're welcome.
No problem.
Okay. Goodbye. I'm signing off.
All right. Take care, guys.